Now, there are people who can do the tail part, hyper concentrate and get it right, but the probability is lower. And then you break the first rule, which is don't this up. Because if you get taken out in the cycle and lose your capital, and this cycle is going from 2.5 trillion to 100 trillion, that's bad.
After weeks of fear, doubt, and uncertainty caused by several short-term headwinds, most notably the German government's sale of 50,000 Bitcoin, the cryptocurrency market has staged a much-anticipated recovery, and we are once again on track to see higher prices for Bitcoin and other cryptocurrencies. The outstanding performance of spot Bitcoin ETFs is helping to drive the recovery. According to Farsight Investors, U.S. spot Bitcoin ETFs experienced significant inflows of $422.5 million on Tuesday, the largest peak recorded in July. BlackRock's IBIT saw the most inflows, totaling $260.2 million, followed by Fidelity's FBTC, ARK21 shares, ARKB, and VanEck's HODL, which received $61.1 million, $29.8 million, and $22 million correspondingly. In the 3 trading days ending on Tuesday, the spot Bitcoin ETFs received more than $1 billion in inflows, indicating a very optimistic sign for the ETFs and underlying cryptocurrency. In a Twitter post on Tuesday, Bloomberg ETF analyst Eric Balchunas provided an update on the ETFs, praising how much they had exceeded his expectations in just 6 months. His article states, "The Bitcoin ETFs are in 2 steps forward mode after 1 step back in June, with another $300 million yesterday and $1 billion this week. The most notable number among these is the year-to-date net total, which has surpassed $16 billion for the first time. Our estimate for the first 12 months was $12 to $15 billion. That is already resolved, with 6 months to go." Eric anticipates that multimillion-dollar allocations to ETFs will increase in the next days and weeks as the Bitcoin market and global liquidity conditions become more intriguing. Raoul Pal, the founder and CEO of Real Vision, shares similar views, particularly on global liquidity conditions, which he believes are about to reverse. When this occurs, Pal anticipates an immediate response in asset prices. He expects large price gains in all assets, but nothing near to his forecast for the cryptocurrency market, which he described as the fastest horse in the race. Pal predicts that between now and late 2025, the total cryptocurrency market capitalization would rise from less than $2.5 trillion to $12 to $15 trillion, with values for cryptocurrencies such as Bitcoin, Ethereum, and Solana at least quadrupled.
I don't care what people's philosophies are. That's not how you make money. What you make money on is owning the best performing asset on a risk-adjusted basis. So what I tend to find is that the mid to upper part of the curve, which is networks gaining adoption, do best. ETH last cycle, Solana this cycle, and whoever it's going to be this cycle, whether it's Sui or whether it's Near or whatever it is, I don't know. We will see that, right? That is the easiest opportunity we get in the space to generate wealth. So firstly, focus on that. That's the do not f this up thesis. If we're going from 2.5 trillion to 100 trillion, do that, you'll make a lot of money.
Yeah.
And so then I just filter out as many people as possible. I really only get signal from a few people that I'll ever listen to. If you tweet something, I'll always read what you tweet because I think you'll have a high signal to noise ratio. Most people are high noise to signal ratio. And so I'll observe it for sentiment and any nuggets, but I try and filter out as much as possible and just stick with, unless something shows that network adoption is slowing, I'm right. So just capture that.
Right.
Then I don't FOMO in the rest. I just don't do it. I did that last cycle. I tried to spread amongst this narrative, that narrative. What I do now is really simple. It's idiot proof. I just put the chart against Solana. If something looks like it's a sustained trend against Solana, I'll allocate some capital to it. And again, only about 10% of my portfolio will I do in that kind of stuff. But you can make a lot of money in those. And so, that's what got me into WIF and Bonk, because they were outperforming Solana. So I'm like, okay, I can do that. And now, if anybody shills me something, I just say, well, show me the chart outperforming Solana, and I'll take a look. That discipline makes it ultra easy for me, because I think because of this everything code liquidity cycle, everything is correlated, every asset in the world, which makes it and it's all driven by the same debt refi cycle, which makes it, I think, the easiest macro risk-taking environment of all time. because the central banks have also taken the left tail out by saying we can't let collateral fall too far, so we will debase currency. Holy shit, if this is the case, then we have the simplest, easiest risk-taking opportunity of all time. So hyper-concentrate, I think, is the way. Now, there are people who can do the tail part, hyper-concentrate and get it right. But the probability is lower. And then you break the first rule, which is don't f this up. Because if you get taken out in the cycle and lose your capital, and this cycle is going from 2.5 trillion to 100 trillion, that's bad. People are insanely fearful of the short stunted cycle, end of the cycle last time. And I remember the 2017 top and how bananas that was, and the 2013.
Yeah.
And like 2013, 2017 were much more similar than the last one. And don't forget, we'd gone through a global pandemic. There was a lot of other factors at play. So I'm like, that was probably the outlier. Don't expect everything to repeat perfectly. But like you, I'm probabilistically saying, well, it just probably goes to the end of the year. My macro work on liquidity says liquidity peaks out, not goes negative or does anything else, just peaks out by about June or July. So
of 25.
So, but I'm seeing Twitter just tie itself in knots about that fear of the last stage part. And so they desperately want to sell earlier.
Yeah.
They're so scared of it that they want to sell earlier, which makes me think the 2013 cycle feels more similar, where everyone's going to try and take profit. The market goes down and then rips in your face again because it's not over yet.
Powell believes that as liquidity circumstances improve ahead of the November presidential elections in the United States, the cryptocurrency market will finally get the gasoline it needs to shift from the boring zone to the banana zone, which is the phase of every crypto bull market where prices suddenly tear higher. And the market goes utterly nuts. The Real Vision CEO and former Goldman Sachs executive believes we haven't seen it yet due to the Federal Reserve's emphasis on keeping interest rates higher for longer to reduce inflation. However, traders are now 100% positive that the Federal Reserve will lower interest rates by September. According to the CME FedWatch tool, there are now 91.7% probabilities that the Fed's target range for federal funds rates will be reduced by a 0.25 percentage point from the current 5.2, 5 to 5.5, or 0% to 5% to 5.25%. According to the tool, some traders believe there are 4.5% chances that the central bank would lower rates by a 0.25% at the conclusion of its July meeting, followed by another drop in September, for a total of 100% chances of Fed rate cuts by September. According to Powell, rate reduction, potentially even stimulus checks,
yet.
and
As
the
shown by the
reintroduction
number of
of
active traders on
quantitative easing
Coinbase and other
operations would
exchanges, it's
begin
really
before the
just
November
institutional
elections,
investors moving
causing
everything so
asset
quickly.
values to rise substantially.
Plus macro.
Two parts to what drives assets generally, particularly the ones driven by liquidity, long duration assets. Liquidity, is my belief, is not a flow of funds. It's just a pure debasement of currency. Inject money here, debasement there, asset optically goes up in value. So, because I went through this for ages, and this is what got me, I was mid-curving the whole damn thing for so long, because I was like, I can't see when there is liquidity or QE, there's no extra volume in the equity market. So therefore, it can't be doing anything. And that sat in my head for 2 years before I finally went, oh, because it's just re-rating. I saw it in the Cayman Islands over COVID. I mean, property prices went up 50% like that. It wasn't because they traded. They just went there because of liquidity. I'm like, okay, I'm starting to get it. It's this like magic force that we kind of don't see. And the global debasement is about 8% a year. So we're mutualizing the cost of the servicing the debt across everybody in the world by about 8% a year. And that's like a tax. The other way I looked at this, because at first, like, how dare they tax us? Then you say, well, what price would you put on a put option that your equities don't go down more than 30% and that your house prices are secured and the global economy is secured? Would you pay 8% a year for that put option? Yeah, it's probably not wildly mispriced.
Yeah.
You know,
that's so
and that's kind of changed my head. This is why I think we've taken the left tail risk out, because we're basically using this 8% as a put option in the entire system. So the other question you're asking is, okay, this is more about the flows, the actual flows. And I'm thinking here of whether it's into tech stocks or whether it's from fiat world to crypto land, that bridge, let's say the Bitcoin ETF bridge, which is, I think of as hot money flows and VC as foreign direct investment. Yeah. So what drives both of those flows is really simple. It's the business cycle. Why? Because when earnings go up, people have more money to invest.
Yeah.
And so the flows pick up. So right now, if we look at the ISM, it's still kind of below 50 and struggling to pick up. The forward-looking indicators are screaming higher. So it's about to pick up. But we're not seeing mass retail participation in crypto. Why? Because jobs are still a bit tight. The economy's still a bit shitty. People just don't have the liquidity. You know it from the VC business is nobody's had releases of liquidity, right? All the way from the stack, from private equity all the way down to growth VC, there's a real problem, except in the early stage token stuff. That's it.
Yeah.
So capital is trapped because there's no earnings going up. So if you think of Tesla stock, why is Tesla stock relatively low, even though it's got all of the technology stuff? Is because people buy cars when they've got money and they don't have much money right now. Rates are a bit high. So that business cycle, as that picks up, now, again, if you go back to the everything code and the crypto and the macro seasons or crypto seasons, the macro summer is really when the ISM starts going up, earnings start increasing, and guess what? The world's awash with risk taking. So it's as simple as that, I think, which is why it's so beautifully on repeat.
As central banks begin to decrease interest rates and ease their quantitative tightening measures, Pal expects a most exciting moment for the cryptocurrency market, with crypto asset prices predicted to climb sharply or go completely nuts. This is the banana zone, and Pal expects it to start at any time. Unlike others, Pal is positive about the US and the global economy, and this confidence originates from central banks' proclivity to intervene anytime there is even the slightest hint of crisis. They simply cannot afford another global financial crisis, and printing on a regular basis is the only way to delay it. Pal believes that this cycle will continue at least until 2030, when AI and robotics will totally transform the planet. Until then, investing in cryptocurrencies such as Bitcoin, Ethereum, and others can assist investors avoid monetary devaluation and debasement. Do you agree with Raoul Pal's analysis and outlook for the Bitcoin market in 2024 and beyond?